Hello everyone, welcome to Kansas City, Kansas Public Library, main library, to our program Student Loan Forgiveness Act Now. I am Elena Banjur, a librarian with Kansas City, Kansas Public Library, and I am happy to introduce our presenter today, Jason Anderson. Mr. Anderson is a seasoned college consultant focused on affordability, student success, and financial common sense. Jason holds an extensive professional background, including roles as a higher ed instructor, entrepreneur, and professional college and career planning consultant. He is a certified public accountant in the state of Kansas, a certified financial planner professional, certified student loan professional, and holds 2 master's degrees in business and education. Mr. Anderson?
Yeah, thank you. Appreciate it. And by the way, the reason why Kansas City, Kansas Public Library entitled this Student Loan Forgiveness Act Now is one specific topic that we're going to talk about in this webinar, which is public service loan forgiveness. So for those of you that are on the call, if you're working for a nonprofit, if you work for military, government, public service loan forgiveness is a great opportunity for you to get forgiveness after 120 qualifying payments. And recently that program went under a temporary change. We call it the waiver program, and it really makes it quite easy to qualify for qualifying payments, whereas in the past that wasn't the case. And so we'll talk about that. We're going to talk about much more than that in this presentation. We're going to talk about student loans in general, and then we're going to go into strategies on how to manage student loan debt. So just keep that in mind, that we will be talking about a number of these different pieces, but forgiveness is certainly one of them. So we will get to that as we go. Now, I did want, before we start this presentation, this is my disclaimer, not my first, but certainly probably the most important. So I do run this firm called Gradmetrics, where I do college and student loan planning with clients. But I have another role. I am a lecturer in the School of Business at the University of Kansas. And so I do like to say at the beginning of my presentations which hat I'm wearing in any given time. And today I'm wearing my Gradmetrics hat. I'm not wearing my KU hat. So keep that in mind as I go throughout this, that's the capacity in which I'm speaking to you. Okay, so we're going to talk about financial aid. That's really how student loans start, is in this package of financial aid that we're given to go to school. Or maybe for some on this call, it might be a dependent. Maybe you took out a Parent Plus loan for your kids to go to school. And if that's the case, then certainly it always originates from financial aid and what you're given there. Then we'll talk about student loans in general. And then finally, we're going to wrap up this presentation, which this is the portion which many of you all are probably looking forward to, and that's the strategies to manage student loan debt. So we're going to talk about that, and there are quite a few out there, especially when we consider what we call federal student loans, which we'll discuss the difference between that as we go along. Okay, financial aid. So financial aid 101. So really all student loans start with this idea of the FAFSA. So sometimes you get free money from the FAFSA. Sometimes you get money that has to be paid back. So you might get grants, you might get scholarships, of course, money that doesn't have to be paid back, but also included in federal financial aid in particular are student loans, and they come in different flavors. And so getting the terminology correct in terms of what type of loans we're talking about is important before we start talking about strategies. So federal student loans in particular, you're going to have subsidized and unsubsidized loans. You might also have direct loans versus other types of loans. You might have what's called PLUS loans, which we tend to see those for parents taking out loans or graduate students taking out loans. And again, the categories here are important because especially with the cost of your loan, i.e., the interest rates and the fees that you're going to be charged will change depending on which type of loan you get. Then we have private scholarships and also private loans. Now, this presentation is really going to focus on federal student loans, but we will talk about private student loans briefly at the end of the presentation and what to do if you have private student loans. So need-based programs, these categories really are based on whether you have financial need for college or not. So if you have need and you can demonstrate that through the FAFSA or even some additional financial aid applications like the CSS profile, if you demonstrate that you have financial need to go to college, that's when this type of money comes to you. It would be like free money. Maybe you've heard of the Pell Grant or the Federal Supplemental Educational Opportunity Grant, and you might get subsidized loans. So this is when the government is paying for that interest while you're in school. And actually right now with federal student loans, the majority of them anyway, you're actually getting your interest paid for as a part of COVID stimulus. And we're going to talk about that. And then you might be given something called work study, which is federal student aid in which you're working on campus and the federal government is essentially paying your check. So that's another aid-based package that would come to you if you demonstrate financial need. But certainly not all families are going to demonstrate financial need. So you might get unsubsidized loans. That means that when you take out the debt, your interest starts to accrue. Now, maybe you may not have to pay anything while you're in school, for instance, or during a grace period, which would happen after you've graduated. You're probably going to get about 6 months to get all your affairs together before you have to start paying on those student loans. But your interest is going to accrue from the beginning, meaning that, and especially, by the way, when you start paying, all that interest gets added to principal, something we call capitalization. It makes your loan more costly over time. So you may qualify for that. And by the way, there still is free money out there for certain professions. So one good example there is the teacher education access, or what we call the Teach Grant for teachers, where they can essentially get a piece of their loans forgiven if they meet certain qualifications as a teacher. So there are free kind of stimulus, well, I guess free aid that can even go to families that don't demonstrate need. And we tend to see those programs for the type of occupations that have high demand, medical professions, teachers, et cetera. So how much can you get? Here's just a basic table outlining what type of aid you might get. And what's interesting about this table as we talk about student loans, specifically, because of free money, that's not what we're really talking about here. We're talking about the loans that you have to pay back. So I'm not too worried about the first portion of this table. But what's interesting, especially when we get into loans, for undergraduates, it tends to be capped. And what that means is that undergraduate students, and I'll show you another table that will go more into detail on this, but undergraduates can only take out a specific amount of debt on the federal side, and then it's capped out. And it's really capped out at about 20. It's technically capped out at 31, but it's doled out in a certain percentage every year. And so we tend to see, like, if you're to graduate in 4 years, you'd only be able to take out 27,000. Well, the problem is higher ed is expensive. And so many parents, for instance, have to step in and maybe take out debt for their children because that 31,000 is not enough for them to live on campus and go to school for 4 years. So when we look down here at this last category in particular, the Direct Plus loans, those are the loans that are going to parents that are borrowing on behalf of their students. It also goes to graduate students that are trying to take out debt for graduate school in many cases. Now, it may not be all your debt, but certainly this will likely be a piece of it. And these are at higher interest rates, they're higher fees, and it tends to be based on cost of attendance, which means in theory, you really can take out a lot of money in this category. So when we hear these horror stories of someone taking out 350,000 in debt, it is likely due to Parent Plus loans or Graduate Plus loans that they're taking that out because they're able to borrow up to the full cost of attendance. So we tend to see higher balances. It can get scary pretty quick. Okay, so now we're going to talk about student loans, focus in on that. So this is a hypothetical question. I don't expect anybody to answer, but what do you think is the average student loan payment today? Monthly student loan payment, what do you think that number is? Well, that number right now is $393 a month. And actually, this tends to be really skewed low in many respects because we're talking about undergraduate students coming out with less debt because, again, I told you that there's a cap for undergraduate students. But on the other end of the spectrum, when we look at like graduate students going for their med degree, for instance, Not uncommon for me to work with clients that have north of 200, 300,000 in debt. And it can get, again, pretty scary pretty quick in terms of high debt loads. So this could easily be 1,000 a month, 2,000 a month, depending on your specific scenario. And I certainly have seen scenarios where people are taking a lot more. It's also becoming a national epidemic. And actually, I'm looking at doing research right now on my faculty role side about student loans and some of the pressure on the Biden administration in particular to cancel student loan debt. One of the reasons why that's the case is because we have an insane amount of student loan debt out there. So to give perspective to this $1.73 trillion number, first off, it's ballooning all the time. When I first got into the industry, I think it was at like 1.2, and now it's at 1.7, and we're talking trillions. Okay, so these are massive numbers. So it's going up all the time. But if we think about credit card debt, there's only about $1 trillion in credit card debt across the United States. So we have 1.7 in student loan debts. It's like dwarfs what we have in credit card debt, which is kind of crazy when you think about it. There's also pretty high delinquency rates. And then the reason why, especially in this presentation, we're focusing on federal student loans is because we have quite a lot out there that have federal student loans, 42.9 million people that are carrying federal student loan debt right now. If we look at this by state, in Kansas, which I'm a Kansan, we like to see that lighter blue color, but you can see this map actually tells us a story about student loan debt. So our neighbor, Missouri, actually is not doing too well. Certainly Illinois is not. But if you look at the areas that have higher student loan debt, and basically higher than average, we're looking at areas that have higher costs of living. So you see the Northeast, you see the coasts, you see some of these other areas that it's going to be more expensive to live. And so people are actually coming out with greater than average debt loads in those states. Luckily in Kansas, we're doing a lot better. But speaking of Kansas, and by the way, I'm a doc student in personal financial planning at K-State. So I get to pick on K-State a little bit here. But one of the reasons why we have so much student loan debt is because the costs of higher ed have just ballooned into the stratosphere. So state or public schools like K-State are supposed to be affordable, right? That's why they were established. But if we really think about the cost of a place like K-State in today's dollars, if we take the whole full cost of attendance, so this is tuition, fees, personal expenses, transportation expenses, living on campus, room and board, fees, what do you think it costs to go to K-State for 1 year in today's dollars, living on campus? Again, rhetorical question, but this may surprise you. It's $27,185. By the way, most colleges don't just keep their tuition flat every year. And so if we add in a 5% increase, that means in 4 years, which a lot of students don't graduate in 4 years, by the way. But if you were to graduate in 4 years, your total bill is going to be about $120,000. It's kind of crazy. That's like basically what a house costs, in some areas of the United States. So it's kind of shocking. And that's why we're seeing a lot of student loan debt. So what are the two main types? Again, I'm going to focus on federal student loans. These are loans that are funded by the federal government, essentially. So we see a lot of this out there when you're filling out the FAFSA, for instance. That's what you're going for. On the private student loan side, you can also get private student loans. So if you have a loan that you directly applied for with Sallie Mae, for instance, or another financial institution, you likely have a private student loan. And many of the strategies and benefits that we're talking about in this webinar will essentially not be applicable to your type of debt. So talking mostly about federal student debt here. And again, we have different types of federal student debt. You have subsidized loans, unsubsidized loans. Then you also have those plus loans that we talked about. And again, there is a cap when it comes to these undergraduate loans. You're going to be capped at about $31,000 if you're a dependent student. So you can't take out unlimited debt, but your parents can certainly take out a lot more. And you can certainly take out a lot more if you're a graduate student as well. So those plus loans, we do see a lot more debt come out in this category in particular. Okay, and by the way, I'm going through this. I will field questions at the end of this. I'm happy to answer your questions. And you can also see in my name box for my video screen here, it has my email, and you'll get my contact information at the end of this presentation. So always feel free to email me questions as well if you don't want to bring it up in this webinar, especially since it's recorded. So I told you that these different categories of federal student debt will vary based on how much they cost. So if we're looking at undergraduate borrowers that are maybe getting subsidized or unsubsidized loans, lower interest rates and actually close to historically low interest rates on that debt. But when we get to graduate and professional borrowers, it gets more expensive. And so when we're talking about those direct plus loans, it's actually 6.28%. By the way, these interest rates change every summer, and I would anticipate that they're going to go up a little bit when we hit the summer. So these aren't cheap loans in many respects, especially when we get at the graduate and professional level. Although I would say at the undergraduate level, it's a pretty competitive interest rate, especially considering most undergraduate students don't have a history of income or even a credit score in many cases. And so that's something that can be good. Another thing that I would just say before I go off this slide is make sure you know about the fees. So the fees to take this out are in like the 1%. But when you get over here to the direct plus loans, you're going to be more like 4%. And so actually this interest rate is going to, in reality, be higher because of those higher fees that you're paying to take out graduate student loans. Okay, so now we've kind of talked a little bit of the history. Why do we have student loan debt? What is it? And especially what are the distinctions between some of the debt classes and what are the advantages and disadvantages? So now we get to talk about why many of you all are probably on this call. And that question is, hey, I have student loan debt. What the heck do I do with it now? So that's really the rest of this presentation is talking about those strategies and some of those things you should be aware of, particularly when you have federal student loan debt. So the first thing you need to be aware of are loan repayment plans, okay? And actually statistics show us that many people are taking out federal student loans. They get through school and they get a grace period where they graduate and they don't have to necessarily pay on that debt. But eventually the Department of Education comes knocking and they say it's time to pay your student loans. And so when that happens, and you have to start repaying, much like a mortgage where you might have a 15-year mortgage or a 30-year mortgage, there are different ways and time periods and methods to pay those student loans. Now, that default method is what we call a standard repayment plan. And we know statistically that most borrowers get slated into this by default because they don't make any change. The thing is, though, is it may not be the best fit for you, okay? And the Department of Education, through loan exit counseling and some other things, do give you some resources to try to coach you as to what is the best repayment plan for you, but many borrowers just don't take them up on that. They slot into the standard plan and it may not be the best fit. So the standard plan is paying it off in 10 years. That's essentially what it is. And this is the default plan. So if you slot into your normal standard plan and you make payments, you will have your student loans paid off in 10 years if they're all federal student loans. But there are other methods to do this. So like if you're on this call and you're like, hey, I can't afford that payment, or you're on this call because loan payments are going to start again on May 1, and you're like, I can't afford it when it restarts, then some of these other methods might be a good fit for you. So one of, and these, by the way, these first three are kind of what we would call standard plans. There are two modifications in particular, the standard plans that some people slot into. So one is graduated. This is where you pay less at the beginning and more as your student loans age, or they get, you get further into that term when you're paying. And of course, these modifications cost you more because if you're paying less at the beginning, you're going to accrue more interest. And so that's kind of the way it goes. It may give you some payment relief at the beginning, at least, with the idea being that hopefully you're going to get work that you would be able to afford better payments towards the end. But one of the crucial things to think about, we're going to talk about public service loan forgiveness, and at least under the original program, this isn't a qualifying repayment plan, okay? So if you're going for public service loan forgiveness, you should avoid the graduated plan. Extended plan is similar. So this is where you're extending beyond that 10-year normal term. You're making it longer. Again, it's going to cost you more money because more interest will accrue, but you might be able to pay off on a longer time frame. Well, when you extend your term, your payments go down, and so you will get some payment relief. But again, this is not a qualifying repayment plan for public service loan forgiveness. So if you are going for public service loan forgiveness or just another option to save on payments if you're not making that much money year to year, are income-driven repayment plans. And so if you're going for public service loan forgiveness, the standard plan isn't really going to help you because you're going to pay it off in 10 years. And public service loan forgiveness is basically a 10-year plan. So your loans will be paid off. Not really helpful for you. The other two plans that we just talked about will not be helpful because they don't qualify, okay? At least not under the original program. We'll talk about the waiver program here in a bit. But income-driven repayment plans do qualify for public service loan forgiveness in many cases. And so they tend to be where borrowers slot if they are going for public service loan forgiveness. So how are these plans different? Well, the difference is that your payments are based on basically your income, generally speaking. They're based on a percentage of your income, and then that's what you pay. So it's not a standard plan where it's like, hey, what's your payment such that you'll pay it off in 10 years? It doesn't even really calculate and pay off. It's just talking about how much can you afford based on what your income is. So they tend to look at your discretionary income, and then they take a percentage of that, like 10 to 20%, and they say that's your payment. So again, this is good for people who can't afford the payments on their loans because they're not making enough money, because then you're basing it off your income, which is likely going to be lower if you can't afford your student loans. So that's how they're different. And these programs are the pay-as-you-earn, revised pay-as-you-earn. There's also a program called income-based repayment, or IBR. There's an old and a new version of this plan. There's also income contingent repayment, which is typically where Parent Plus borrowers will slot in if they consolidate their loans. So there's different categories here. And one thing I would tell you is your mind might be kind of swimming right now in terms of which one's best for me. The Department of Education actually puts together a calculator that you can put in your situation, or you can even log into your account for federal student loans, and it will do some scenario analysis and essentially tell you what's your best program. Another thing you can do is you can call your loan servicer and you can say, hey, I'm interested in an income-based repayment plan, and they can calculate which one will lead to the lowest payment for you. And so those are two places that you can talk with people who can help you through this process. And of course, people come to me every once in a while and I can help them with this as well. But those are some options that you can also take. So there are some differences in these plans. It is rather complex, but I've outlined some of those on this slide. So for instance, IBR, one of the things that you should be aware of is the term of forgiveness. So a lot of times on these plans, these income-based repayment plans, you will get what's called long-term loan forgiveness. So let's say you work in the for-profit world and you don't qualify for public service loan forgiveness. You can slot into one of these plans, and once the term is done, either 20 or 25 years, you'll get forgiveness after that term. So whatever your balance is after the end of 20 or 25 years, it will be forgiven. Now, one thing you should keep in mind here, and I'm not a tax advisor, but if you are going for that long-term 20, 25-year loan forgiveness, which is great that it exists, it is taxable currently. And so you need to plan for that over time. So if you get $200,000 wiped off the map because you got long-term loan forgiveness, that is something you have to pay taxes on, at least the way that the law is currently written. So work with a tax advisor to make sure you're planning for that properly. So those are the income-driven repayment plans. So let's talk about loan forgiveness. Okay, public service loan forgiveness is probably the most well-known plan in loan forgiveness. And these are for people who are employed by government or non-for-profit organizations, also for individuals who are working for a public good in the military. And so what happens here is you're making qualifying payments when you work for a qualified employer, one of these entities that is a nonprofit, government, military, et cetera. And so you make a certain number of qualifying payments, which it's 120. If you divide that by 12, it's a 10-year program, but they don't have to be made consecutively. Then you have to be, at least under the original program, in a qualifying repayment plan, which we talked about that. Some qualify and some don't. Then you have to be working full time. So you can't be working, part-time for a nonprofit and qualify. So there are different pieces that you have to adhere to or qualify for. But if you're making qualifying payments under all of these conditions, after 120 qualifying payments, your federal student loans will be forgiven under this program. Now, one of the things that I would say here is there has been historically a high reject rate in this program. It essentially hasn't worked as intended. And so there have been many programs that have been introduced since the original public service loan forgiveness program that make it easier to qualify. So the first one that we saw was the temporary public service loan forgiveness, which really focused on those that were not in a qualifying repayment plan, giving them forgiveness, even though they weren't in a qualifying repayment plan. And right now, during COVID, we have what's called a waiver program. And so this is through October 31st of 2022, but it essentially is waiving, as the name implies, waiving a lot of the original requirements and allowing people to essentially go back and recount some payments that didn't qualify under the original program as now qualifying. And the main two things that you need under the waiver program are qualifying employment. So you still need to work for a nonprofit, government, or military, and you're working full time. And then you have to have the right type of loan, which you need direct loans in particular. But there is a way that if you don't have direct loans, that you're able to potentially consolidate and make them direct loans and then qualify under this waiver program. So keep that in mind. That's a really great program right now. It is temporary because it's a COVID-19 measure. And it's something that can allow more people to qualify for public service loan forgiveness. So that's certainly a program to look into if you are working for a nonprofit, government, or military type organization. Another opportunity is teacher loan forgiveness. Also, if you're a nurse or a medical professional, there tend to be really good loan forgiveness programs in those categories. And then I would encourage you to look at state-based opportunities. So Kansas, for instance, has some interesting programs out there. So one of the programs in the state of Kansas, is that we have rural loan forgiveness. So if you have a desire to go and work in a rural county and you meet the requirements, I believe the current program is it will allow you to forgive 16 or 17,000 of your student loan debts by living and working in a rural county. And so there are all sorts of miniature programs at the state level that can also help you get loan forgiveness. And then this one in the middle, or the two in the middle really, that are not as common, but you should know that they exist, are discharge by death or disability. So if you find yourself in a situation, or maybe you took out Parent Plus loans on behalf of a kid who has since passed away, you can get discharges for death and disability and things like that. Another is what we call borrower's defense or closed school or false certification. So if you went to a for-profit school in particular, is when we see this play out in most instances, and that school closed, or that school engaged in fraudulent behavior, there are opportunities to essentially petition the Department of Education to forgive your loans. And especially under the Biden administration, we're seeing a lot more traction in that category than we are with the Trump administration. So that's another thing. If you feel like your school took advantage of you and you were maybe told, hey, do this program with us, take out these loans, and you're going to get this great job with great earning potential, and you were essentially lied to, that would be a scenario where you would potentially get borrower's defense type forgiveness. Okay, so I've talked about how public service loan forgiveness has changed during COVID-19, but how have federal loans changed, and what are some of the incentive programs during COVID-19 for federal student loans? Well, right now, if you have qualifying federal student loans, you probably noticed you're not making payments and you're not paying interest right now, which is really great. And actually, that is the same for people who are currently in school. So for instance, I'm taking out some student loans for my doctoral program. I'm not currently paying interest on those. But that all ends unless it gets extended again. It's been extended several times, but I wouldn't anticipate that it gets extended again. It's possible, but that ends May 1st, 2022. So come May 1st, 2022, you will have to start making payments again, and your interest will kick back in, and we'll start having to pay interest on federal student debt. But there have been some really cool perks to this program for federal student loans. In addition to not paying interest or payments, these also qualify. So those payments you're not making are still qualifying for public service loan forgiveness if you're meeting some of those other criteria. They also are counting towards that long-term loan forgiveness that I talked about under an income-driven repayment plan. And so you're still getting credit even though you're not making payments, which is really cool, meaning that you haven't had to pay out anything and you're still getting that benefit. So keep that in mind too. If you've been on the public service loan forgiveness train, or you're thinking about submitting an application to see if you're eligible and getting those eligible payments kind of calculated within your student loan dashboard, then you may be pleasantly surprised to see that you've gained credit during this time you haven't been making payments, which is pretty cool. There are some other initiatives out there, and so I've put the links here for you all to look at those. And I've also put a link to a blog post that I created talking about some of these initiatives as well. So the Biden administration, another question I get fairly frequently is, hey, is Biden going to wipe out my student debt? Okay. And the answer to that is, I don't know. I don't have a crystal ball. Okay. I can't project, or, I just don't know what the future holds, but I will tell you some projections, or I guess some guesses, some educated guesses. So one thing that I would say is Biden in a town hall in February in 2021 did say that, and I think that's February 2021. I hope that's not a typo for 22. But he did say he wouldn't forgive 50,000. So I don't think it's going to be a mass. If there is loan forgiveness from the Biden administration, like blanket loan forgiveness, I do not believe it will be a very high amount up to 50,000, because essentially Biden has already said that that wouldn't happen. But there is still pressure for the administration to blanket forgive something. Like, for instance, Senator Warren is holding some hearings on student loan debt. There's also a bunch of organizations that sent the administration a letter. So what I would say is, if it happens at all, it would likely be limited and lower in scope. So maybe something like 10,000 for those who are in default, just making something up. But that would be my guess, is that if it happens, it's going to be limited and lower in scope. It's not going to be like large amounts of blanket forgiveness. Okay. That's my guess, my educated guess. Now, what happens is what happens, if anything at all. But I will tell you, blanket loan forgiveness is tough politically. And so what we've seen from the beginning of the administration is we've seen like the waiver program for public service loan forgiveness. We've seen the extension of zero interest and zero payments. These are easier things to do politically than blanket loan forgiveness. So I would anticipate we'll continue to see improvements on existing programs, maybe even a new income-based repayment plan. But I would be surprised if we get blanket loan forgiveness. Okay, other student loan issues. So one thing that has become a lot more popular is, especially in the hot labor economy that we're in right now, is employer repayment assistance. So a lot more employers, specifically because there are tax advantages now to doing this, are starting to offer benefit programs that will help you pay off your student loans. So when you're out there looking for a job, if you're in the job market or the job hunt, keep an eye out for that. See if there is an employer that would potentially help you pay down student loans. Actually, my employer, before I went into higher education, had a program like this. I believe the details were that if you worked a couple years, you were able to start getting payments on your student loans. So keep an eye out for that. Know that it's an increasing trend. And then finally, if you've gotten to the end of this, you're like, Jason, I have private student loans. All of this was meaningless to me. Well, first thing I would do is I'd apologize. Sorry that it hasn't been that useful. I hope it has. But if you have private student debt, there are still strategies for you. And those strategies tend to be the strategies that mirror private student debt in any category. So credit cards, car loans, mortgages. And what are those? Well, there's really two strategies, three strategies really that we'll talk about. And one is the debt snowball. So this is where you pay off your smallest debt first. Like, let's say you have 8 student loans and one of them has a balance of 50 and the other have balances above 1,000. Then you start with that $50 balance and you pay it off and you get rid of that student loan. Then you move to the next smallest balance, and then you move to the next smallest balance after that. And so what you're doing here is you're building momentum. and you're making it feel good that, hey, I paid that off, I'm moving on to something else. And you start this momentum flywheel effect, and the next thing you know, you've paid off your student loans. Another strategy is what we call the debt avalanche. And this is actually the more efficient way to pay off private student loans, but it's where you start with your highest interest rate first. So you don't start with the highest or the lowest balance, you start with the highest interest rate, you pay the highest interest rates off, and then you move to lower interest rates. And again, this is the most efficient way to pay off your private student debt. Another thing you can look at too is refinancing. So this is a good strategy with private student debt. If you have an improved credit score, or you're essentially able to go out and beat what those initial rates were in the private space, this might be a way that you can save money, especially as interest rates are lower right now. You may have like I've seen student loan interest rates in the private side, they're like north of 10%. And so if you can go and refinance at something more reasonable, that's going to save you a lot of money over time. One thing I would say though, is if you have federal student loans and you refinance those, guess what? You are issued a new private loan and you miss out on a lot of these benefits that we've just talked about. So don't go out and just refinance for another 1% off if you're going to forfeit benefits that are worth way more, like, maybe potential loan forgiveness. And then consolidation is something that you'll hear on the federal student side. Again, it may be a good fit for you, may be a good strategy, but just know what you're doing before you do it. Because when you consolidate your loans on the federal student side, guess what? Your old loans are paid off and you're issued a brand new loan. So let's say on those old loans, you had 4 years worth of payments towards public service loan forgiveness. Chances are that's gone because you're issued a new loan. And so you forfeit all of those benefits that you had on that old loan because you're issued a new loan. So that can be a problem too. So before you go out and consolidate, just for convenience, maybe you have 8 loans and you're just consolidating so you can have one payment to one loan. Before you do that, make sure that you're not missing out on other benefits. Okay, additional resources. So I want to give you some tools that if you have additional questions, you might be able to go to these different places to get help. So the first is you have a loan servicer. So if you have a federal student loan, you have someone who essentially administers your loan. And so like I think Nelnet is mine, and I can call up Nelnet and I can say, hey, these are my student loans. I have questions like, what's my best income driven repayment plan? And they have people who can answer those questions. And so you can always call your servicer with questions. And there is always an updated list on the next website I'm going to show you, which is studentaid.gov. So if you have federal student loans, your best resource is going to be studentaid.gov. By the way, the government also has a hotline, and it's 1-800-4FED-AID. And so this is a place that you can call when you have questions about federal student aid, and they can answer some of those questions. So these are 2 additional resources for you. Then I have a blog at gradmetrics.com. So I'm always blogging and talking about different college and student loan planning topics. So that can be a good resource for you. I also have a podcast called Grad Centric. And so I recently, over the last couple of days, and I've got more that are publishing in the next few weeks, I'm talking about student loan debt. And so that can be a good resource for you as well. Feel free to follow me there. And then finally, I would say, of course, you can have my contact information. So Jason at gradmetrics.com is the best email to get me. Also have a cell phone listed there. You can call or text that number. And I'm happy to follow up with you in that method as well. And I do post, give me a little bit after this presentation because I haven't posted it yet, but I will PDF this presentation and I will post it at gradmetrics.com/workshops. There's also other workshops that I've done that I've posted some content at that page. So if you want the slides to this, feel free to essentially get the PDF and download it from there. So anyway, I'm going to stop there. It looks like we might have a few questions and I can answer those, but that is the end of my presentation. So I'll give you all a few minutes to start asking questions. And of course, if the library wants to say something at this point, I'll turn it over to them as well, but I'll start reading through some of these questions. Okay, perfect. Well, I can start answering questions then. So yes, the first question is about some shuffling with federal student loan servicers. So yes, there's some shifting with federal student loan servicers right now. So what does it mean for you? And it's always good to kind of keep up with what's going on with your student loan servicer. For instance, I believe it was Navient that just announced they were going to have to forgive a bunch of student loans because of something that I'm sure they had done an error in the past. And so there's always news coming out from servicers, but there certainly are servicers that have decided to get out of the business over time. And what tends to happen in those cases is either they shift their book of business to another servicer, or they maybe spin off another company that will essentially take over your student loans. And so in those cases, the servicer, and the second part of that question is, does it impact our options? And the answer to that is not really. Think of your servicer as an administrator over your loans. They are not like necessarily the ones that are creating programs like public service loan forgiveness. Now, in many cases, they're required to tell you about these programs, but they're not originating from your servicer. And so it's not going to affect your eligibility for something like public service loan forgiveness. That's a federal program. That's not like a servicer level program. Now, I will tell you, when you do public service loan forgiveness, you may be switched to a specific servicer that works in that category of forgiveness, but it's not that servicer that's giving it because of their own free will. They're doing it based on law. And so, yes, public service loan forgiveness is something you can qualify for if you're meeting those criteria. So I don't think it'll change your options per se. It will just maybe be a different type of login, maybe different looking communications, but they all do similar work in most respects. It also says, please clarify your note, the waiver program. So the waiver program is public service loan forgiveness. And you can actually look on that studentaid.gov website. They have a really good tutorial and explanation as to what the waiver is. They also have a great frequently asked questions section. But essentially, the waiver program is a temporary measure for public service loan forgiveness to try to get more people to qualify for public service loan forgiveness. And so it's an additional program to make it not have such a high fail rate, essentially. And like I said previously, what the waiver has essentially done is that original program has all those categories you need to qualify under, like full-time employment, right repayment plan, eventually 120 qualifying payments. So there's all these different categories that you have to meet. Well, the waiver program is essentially temporarily waived some of those requirements, such that right now, if you have qualifying employment and you have the right type of loan, a lot of times you can go back and get credit for payments that you wouldn't have got credit for in the past. And so it's an incentive measure. And by the way, many of the servicers are actually going back and kind of computing this automatically. So there are borrowers that essentially wake up one day and voila, their student loans are gone because they were maybe denied in the past because their payments didn't qualify. And under this payment program, it essentially does, the waiver program, it essentially does. So that's a little more on the waiver program. But again, if you want specifics or you think you might qualify for that, check out studentaid.gov, and it has a great page on what the waiver program is and frequently asked questions. But I would say if you do qualify or think you might qualify, that's one of the reasons why I'm doing this webinar and have reached out to all the libraries and said, hey, let's do this, because it is temporary. That waiver expires October 2022. So if you don't take specific types of action by the deadline, you may miss out on the perks of the waiver program. And then another question, do you have to consolidate and make the direct loans prior to applying, or can you do it after you apply? So if you're talking about the waiver program, I talked about you have to be, basically those two things you really need to be worried about under the waiver program are qualifying employment and then the right loans. And so the right loans are direct loans. And so if you find yourself in a loan category that's not direct loans, part of the waiver program is encouraging you to consolidate such that you get into the right type of loan, excuse me. So again, if you think you qualify and maybe you don't have direct loans, but they're federal student loans, I would certainly encourage you to look at the waiver program and see if you qualify, because some of the action that you need to take by that deadline might be consolidating such that you're in the right loans. So yes, that would certainly be something to consider under the waiver program if you think you qualify. And that's the end of the questions. So any other questions before we call it quits on this webinar?
I have a question.
Sure.
So, do all servicers have similar requirements in certification for public service loan forgiveness, like once a year, and also
Sure.
certification of the salary or wages to qualify for?
So those are two different processes. So essentially on the income verification, so if you're in an income-driven repayment plan, you will have to annually certify your income. And so depending on if your income goes up or down, you will submit paperwork to your servicer. You'll tell that servicer and document what your income is. Well, you document it in some cases, but you're telling them what your income is. And then they will recalculate your payment based on whatever you documented. So your payment could go up, your payment could go down depending on your income. So that has to be done annually. And actually, if you don't do that annually, the servicer will try to remind you, and then they're going to put you in an alternative plan, which you don't want to be in. Okay. It's essentially gonna, in most cases, make your payment go way up because it kind of mimics the standard plan. And I have seen that happen. So you need to fill out your income paperwork. Okay. So that is a requirement. If you are in an income-driven repayment plan, you must do that or you will be penalized. On the other end is public service loan forgiveness paperwork. And so you can, at your own discretion, before you qualify at the end of 120 qualifying payments, you can fill out public service loan forgiveness paperwork. And essentially what this is you're getting your employer to say that they're a qualifying employer. You're talking about why you think you qualify. Then you're submitting that paperwork saying, hey, I'm raising my hand. I want to qualify for public service loan forgiveness. And when you do that, one, you may be shifted to the servicer that works in public loan forgiveness. That may be one I say a consequence, but it's not like a negative consequence. That may be one of the things that happens. The second thing is that servicer will essentially process your paperwork. And let's say you've worked a year in public service and you qualify under these other criteria. What will happen is they'll do that paperwork. They'll say, oh yeah, you do qualify. And they'll say you've made 12 qualifying payments. And that will update in your dashboard. And it gives you this peace of mind that you're making progress towards public service loan forgiveness. But it's not required. Okay. You don't have to do that annually. You don't have to do it until the end when you want to get public service loan forgiveness. But what happens is a lot of us encourage people to fill out that paperwork regularly, maybe annually, or maybe when you're switching employers, like if you work for one nonprofit and then switch to another, to give you peace of mind that you're making progress. And so that way you're not getting to the end where you think you've made 10 years of qualifying payments. All of a sudden you submit it and they're like, hey, this wasn't a qualifying employer. Like then, you're 10 years into it and you realize you didn't qualify. That doesn't make sense. So not a requirement, but certainly best practice to fill out public service loan forgiveness paperwork regularly to make sure that you're making progress.
Thank you.
Yeah, another question, will signing up for public service loan forgiveness change my payment? Or can I keep my current repayment program even if I join the program? Yes, so it won't change your payment. You do want to make sure that you're in a qualifying repayment program, but it's separate. Like whatever your repayment program is, that's what your repayment program is. You don't have to be in a specific one to be in public service loan forgiveness, as in like there's a public service loan forgiveness repayment plan. You do have to be in one that's qualifying for public service loan forgiveness. So what happens is many people are in an income-driven repayment plan when they're pursuing public service loan forgiveness, and that's their preferred method. And so it could be pay as you earn, it could be revised pay as you earn, it could be ICR, it could be IBR, old and new. There are a number of different programs that would fit that category, but what your payment program is and what public service loan forgiveness are kind of two different things. It's not tied to your payment. An income-driven repayment plan will be tied to your income. That's what's going to be dictating your payment.
So what is new IBR plan? You said IBR is old and new.
Yeah, so there's over time. So the first income-driven repayment plan was introduced many years ago, and over time they have been modified, and new plans have come into existence. And so, like old IBR was the first IBR plan that we saw. Income-based repayment. And so over time, instead of necessarily modifying the first one, they just added another one. And so a lot of times, depending on when your loans were issued, whether you were a new borrower when those loans were issued, the timing of your loans will dictate what programs you qualify for, income-based repayment programs you qualify for. So it is very possible that maybe you go and log on to that studentaid.gov website. You do that scenario planner that I told you about, and like you don't qualify for old IBR because the dates of your loans under law, like you just don't qualify for that program, but you might qualify for new IBR. So essentially, it's just the plans have changed and modified over time. You may qualify for some and not others. But generally speaking, so let me give you just one example. If you have a Parent Plus loan and you have the original Parent Plus loan, you will qualify for no other plans but standard plan. But if you consolidate that Parent Plus loan, then you become eligible for ICR. But that is the only income-driven repayment plan that you will qualify for unless you take additional action. And so it depends on the types of loans that you have. It depends on the timing of when you took them out. You may or may not qualify for some loans or for some repayment plans, and you may qualify for others.
Thank you. And we have another question in the chat.
Okay. It says, can you add a loan while making qualifying payments? Or will the new loan restart the plan or for public service loan forgiveness? So it depends on what you mean by getting a new loan. If let's say, and this scenario doesn't happen often unless it's like you went to undergrad many years ago, payments have started on those loans, and then maybe you went to grad school after that. And you started making payments on those loans separately, or you're in a grace period, you're just exiting grace period. I also see it sometimes like maybe you have a Parent Plus loan, and then maybe you have loans for your own education. So you can have different public service loan forgiveness credits and timing for different types of loans. That certainly can happen. But to your question, like let's say you have undergraduate loans, you've made 6 years of qualifying payments on those for public service loan forgiveness. That's going to have kind of its own tally. And if you got new loans for getting like a PhD or something, then those will start their own tally when they come out of grace period and you start making payments on those. So you certainly can have different tallies depending on what types of loans you have and if you're adding new ones or consolidating, things like that. And like I said earlier, if you consolidate loans, you restart the clock in many instances. And so you can shoot yourself in the foot by doing things like that without knowing what you're doing. Yeah, so pretty complex, but hopefully I've opened your eyes at least to some things that you can do for some additional research to make sure you're not missing out on important programs that could save you literally hundreds of thousands of dollars. Public service loan forgiveness could literally do that. And so, keep that in mind. Be in the right repayment plan. Know if you qualify for some loan forgiveness opportunities, and make some good decisions when it comes to consolidating, refinancing. Don't make any missteps there and lose some credits. And you should be on at least a better path than most people when it comes to student loans.
Thank you very much, Mr. Anderson. This was very informative and very helpful. I'm
Great.
sure everybody agrees with me.
Great. Well, again, you got my contact information. If I can be of assistance, please let me know. I'm happy to be of help in the ways that I can.
Thank you very much, everybody, for attending, and everybody have a great day.
All right. Thanks. Goodbye.
Goodbye.